I'm Doug MacKenzie.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Hi, John.
Hey, Doug. How are you?
I'm all right. How about you?
Good. Sitting here with a nice warm cup of tea on a beautiful spring day. So, yep.
How classy of you.
Huh?
I said, how classy.
Yeah, Mr. Worldly over here. Yeah. Yeah. Can't take me anywhere. But yeah, good day. And just the start of March Madness, so let's get this.
And I know you're into that, so.
I am into that. Yeah,
yes.
It's fun. It's fun, and it's a crazy time at the very beginning of it, right? So there's a lot of upsets and those kinds of things. So yeah, it's a nice time of year, and I enjoy it with my two sons quite a bit. So it's
That's
nice
great
bonding thing for us.
Nice. Yeah.
So, what are we going to talk about today?
I don't know. I guess we haven't thought about it.
Yeah, I've always got something going. Let's get right into some thoughts I had.
Well, we're talking about equipment financing, right? I mean, going off of some, he talks about that a lot in the book.
Yeah. Well, it's a pretty big section of the book, where he gets into all the illustrations and that title alone for me is always said. We might not even think of it that way, but equipment financing, that sounds like that has nothing to do with me, right? I don't know, I don't buy equipment, and I I guess again, if you buy cars, you call that equipment, get you to and fro. But they're thinking about some company that has, so it might even get some people to like skip right over it, especially when they start to see these illustrations, and when you're reading it, you're kind of flipping back and forth, and he's referring back and forth to different illustrations and telling you to compare it one to the other. But that's not really the stuff I want to necessarily focus on today.
Well, it's the idea that he's conveying. I mean,
you're right.
Everything he does in that book is to kind of prove a point. So he talks he uses a lot of examples, he uses a lot of parables. And when I talk to people that say they don't like the book, or I don't know, typically they take it too literally.
I think that's a great point, Doug. Thank you for slowing me down enough to, that's an important point to grab onto, everyone, that it is the concept. He's just using examples to try to convey the concept behind infinite banking. He's not always saying this is exactly, but using your imagination, because he likes to use that word, you can quickly figure out how this does fit into your own life.
And he does say that. He says that explicitly a lot of times. Like, don't get too hung up on this. This is just but people get too hung up on the details.
Yeah. And because he's talking about some, things that people never thought about, including me. Like, I never thought about being in the grocery store business. I never thought about flying planes, right?
Right.
Having a sawmill, buying logging trucks and logging shears, and like, okay, this like seems so remote to my existence and my experience. But when you actually sit there and think about it, it's just a story that's explaining the power of all that this is. So,
well, and I think it's really important to go into reading this book with the mentality that you want to identify Like, try to identify with what he's talking about rather than compare and say, oh, that doesn't fit me because I don't, there's some old guy that wrote about this a while ago and all these things aren't relevant to me anymore. But they are. The more you look at it and the more time you spend kind of connecting and relating to what he's talking about, at least with me, the more that I find out that he's talking about exactly things in my life that are very relevant.
Yeah. Well, there is a point where he's in that section, equipment financing, where he gets into this idea who should own the policy. And of course, when you think in equipment financing, you think in business, and yeah, it's a good way to start. Think as a business person. But he says, who should own it? It should be the individual who owns the policy, because then the uh, the owner, the individual, can then do business with their business. And in this case, he's talking about, being one and the same. You are the business owner, but you're also the policy owner, and also become the leasing company. The individual becomes the leasing company. So there's a logging company, and then there's a leasing company. So when you buy a piece of equipment, truck, logging shears, what have you, you end up buying that as an individual and then leasing it and taking back lease payments from the logging company, right? So he gets into the fact you could have all your expenses in one business, and then you've got expenses and depreciation and interest costs, all your operational costs on the leasing company side. So that, he says, you can, write off the lease payments on the logging company side, but the leasing company, the policy owner, the individual, can write off the interest that they're paying to the insurance company for the loan that they have taken, because they've borrowed the money from against their cash value, but they borrowed it from the insurance company. They're paying them an interest rate. They can write that off. They also own the piece of equipment that depreciates, so they can write that off as part of their expense over time, right? So you're catching it on both sides.
So you're creating two businesses rather than incorporating. I mean, you're essentially creating a second business as a lending entity. That's what you're saying.
Yep.
Yeah. Okay. And that makes, and I agree with you. So, and what John's saying is that, that one of the cool things about a life insurance contract is that you can change whoever the policy owner is at any point. So, like, I don't know, John, I probably won't do this, but I could name John the owner of, one of my life insurance policies if I wanted to. I have that freedom. So, likewise, someone could transfer ownership of a policy they have to their business. But what John is saying is that it actually makes more sense to retain personal ownership of that and perhaps essentially create a business entity around that to take advantage of creating a transaction as if you had two separate companies that were doing business together.
Yeah. I mean, and so as Doug, so many people find out or hear the term infinite banking by going down the road of learning how to do real estate investing, right? It's very common. And there's multiple ways to do it, to skin this concept. But you could, with real estate, there could be multiple pieces involved, right? There could be a construction company, there could be a lease management company, right, or a property management company, And it can all start from the individual, right? The individual owns the policy and they borrow the money. They've got their expenses from borrowing from the insurance company. Um, all the while, let's not forget this pile of money keeps growing as long as you're paying premiums and maybe creating multiple branches, but you literally have control over the money that then can go to this contractor who may borrow from you, right? So again, let's say it's 5.5%, but you're charging the contracting company, which could be you. You could be the contracting company, right?
Mm-hmm.
That then does not build this house and sell it. They may keep it and lease it out, right? And then there might be, over time, there might be a dozen homes or maybe apartment buildings. I don't know, right? But literally, then do you want to be in the real estate business? Do you want to be collecting rents? Do you want to be, right? You could literally set up another business, and have somebody, that you hire to run it. But there's, you could have multiple businesses just based off of real estate alone, all within sort of the family banking system.
Yeah, I mean, there's almost endless use cases with this, and I've heard some people. I mean, I hear creative things that people do with this all the time, and it's
Oh, yeah.
always interesting to hear what people think of. But yeah, like you said, I mean, let's say you're a house flipper. House flippers frequently rely on hard money lending, which is super high interest rate, but it's usually for a short period of time. But imagine that you, as a home flipper, could instead start one of these policies or multiple policies, fund them for a few years, and instead of paying an exorbitant amount of interest, you are actually the lending branch that is funding your business. Or you're someone that owns cars with Truro or Uber, and instead of financing those cars through a dealership, you finance them through your lending business. Or you're someone that owns a capital intensive business. Like, let's say you do own a construction company and you buy equipment and trucks all the time, and instead of financing those through the dealership, you just show up and pay cash. I guarantee you, you're going to get better terms that way. And you're also taking advantage of those same things that the dealership would normally take advantage in terms of writing off costs and all those kinds of things. You then do that.
Yep. Yep. And that's, we see it out there. Like you said, I'll go back and I feel like we've been circling around this kind of concept of the whole concept, but this idea of really lending to other people. Um, and that's what Nelson was saying, was to basically wholesale it from the insurance company and then retail it to yourself or others. But yeah, back to yourself, let's say you would typically be going to the hard money lender to get, $50,000 for 6 months or 3 months or whatever it is, because you go right at it with the 50,000. You upgrade the house, you flip the property, you got your profits, and so you're not even paying these high hard money interest rates, which could be 15, could be 18, depending on you know who you are, what your experience with these hard money lenders are, whatever it may be. But why not keep doing that? Why don't you pay the exorbitant interest rate but pay it back to yourself? So
Mm-hmm.
you maybe only be borrowing, sub 6% from the insurance company against your cash value. But, why not pay 15%? And then, you know, say I normally would have had to have done it for this period of time, right? And if it is less because you're paying bigger payments because of this so-called higher interest rate, well, then there's maybe you pay it off in half the time. So that other half you keep paying. You keep paying, and if you can get it in the policy, great. If you have to, you put it into a side account, another savings account, or maybe just hold it in cash. I mean, whatever you want to do. And then when you have, you just got this thing regularly going. There's nothing saying that these life insurance policies have to be, like when we help people, yes, we're helping them get their system up and running. We say, well, if you think you can handle this payment, you certainly should qualify if your health is good because you've got the cash flow to do it. The financial side looks in order to do it. But, it might be, let's just say it was 20,000. Well, you don't have to wait till you have a regular steady 20,000 again. It might be just, hey, I know I'm going to end up with 5,000 a year. Just go get another small branch. It doesn't have to be just as big as the one you had before. And I think people do. I would say for the most part, my clients probably think that way. They're not, when they get a raise of $20,000 a year, which sounds pretty good, but I'm sure some do, and maybe even 10,000. I mean, I would think I would hear from them like, hey, let me get my other 10,000 to work, right? Can I get another policy? Because I'm making more money now. Can I get another policy instead of letting that flitter away from me, right? Because of course, Parkinson's law is that I'm going to end up, spending, my budget's going to go all the way up to my income, right? Well, if you stash it away into a policy, but it's not stashed away forever that you can't leverage it, then just want people that are listening to know, including my clients, your clients, keep adding policies, especially while you can, because you're healthy enough to do it. Just keep doing it. If it was good to do it once, it's good to keep doing it. And I know 70-year-old, I certainly know 70-year-olds that are in this business. They keep adding policies.
Mm.
And I could see that, I'm not that far from that. I'm in my early 60s, but I'll probably keep adding policies, or finding some other person that I can put it on.
Insurable interest.
Yeah, insurable
Sure.
interest. So, yeah. So hopefully that was a good flow.
Yeah. Well, I mean, I think the thing to really highlight there that you talked about is that there are so many ways to utilize this policy, these policies, when people have them, that can really change your financial future in a way that not much else can. And that's really the aspect of infinite banking that's infinite. It's not, it's not that you get exponential growth in a policy, it's what you do outside of the policy with that. And that's really the beauty of it. And that's what we want our listeners to really start to think about, because that's really the whole point of having these is what can I do with these outside of the policy? And he gives a lot of really good examples in the book. And it's right off the bat, you can create a lending entity. It's so easy. You have the best, most advantaged platform to do that with. And there are a lot of people that, whether it's you or other people, that are more than happy to be, paying interest to you in order to have access to money. And with a policy, you have unfettered access to money.
Yeah, I mean, I have a lot of relatives that were in my mom's side of the family, uncles, blood uncles, non-blood uncles that were in the construction business, and they went through the 60s, 70s, and 80s, 90s. Some, got into speculating on houses, right? Just starting to build out a neighborhood before they're even sold. And when the music stops, you can't sell them and all that kind of stuff. But if you were the one that was, you're the lender, and some things don't go as planned, right? You try to be smart about it. I'm not saying be crazy just because you got your own sort of banking system and you can leverage it. But one of the problems, these people end up sometimes losing properties. It might be just one house because the music stopped when they were in the middle of one house, and they've got an outstanding loan. Potentially, because of how much they borrowed, they can hardly get the rent for that home, to sustain the mortgage that they took out, or the construction loan, or what have you. But if you're the lender, yes, for a time you're going to have to weather. Might not be able to put as much money back your towards your payments, what you had planned on paying the insurance company back, being the honest banker that Nelson talks about. But let's just say the rents ended up being cut in half in the marketplace, and they went from $2,000 a month to $1,000. Well, you probably can rent out that place for $1,000, and you got some cash flow, and you are putting some of the money back into your banking system, but you're not losing the property if you don't have the cash flow, right? Like if you can't get 2,000, and because let's just say exactly the construction loan, the mortgage, whatever you have on it, the outstanding loan, you need $2,000 a month just to cover that. And it either means you take some food off your table, your family's table, and you supplement that 2,000 and take 1,500, for example, or hey, I can't even keep this property. It's an extra property. I got to let it go. I got to let the bank take it from me, right? And everything I've put into it. But if you have control over the lending, then you have control over the terms, and you have control over when things have to be paid back. So
Mm-hmm.
I'm
Yeah.
not trying to doomsay here, right? But hey, it can happen, and you have
Yeah, no, that's a really
much
good point. That's a great point.
so much
Didn't
more
think about that.
flexibility, right?
Well, yeah. I mean, I tell you right now, if I stop paying my mortgage, the bank's going to be coming for my house, before the end of the year. That's for
Oh
sure.
yeah, they don't wait
And
very long. No.
right. And of course it would take a very long time to get to the point for most people where a policy is going to be able to you could take out a loan to buy a house in cash and pay your lending
Yeah.
entity. But like just that point, like if I'm a house flipper and I go get a hard money loan from somebody, and I can't pay that back, well, they're probably going to be on the title to that property. They're going to have a lien against it or something like that, and they're going to be coming to take that property. Whereas if I'm taking a loan from my policy and I need some more flexibility, there's no payment schedule at all. Yeah, it's great.
Well, back to, I understand, right? Because I think what you might have been sharing was it may take a while for someone to get to the big enough number in their cash value to buy a house, or that type of thing. But think about all the places people are putting their money, that if they just redirected it into their own banking system. So whether it be 529 plans, or just stashing money in the market because you're thinking, hey, I'm going to get a good return, and over the long haul, I'll be able to pay for the kids' college. And ultimately, what you're doing is you're trying to get them prepared to go out and be independent, financially capable, right? Meaning they get work because of their education, and then they can self-sustain. You want to feel like you've put them on a good track. But think about the fact that if you thought in terms of all the things that they may be able to do that free them to maybe start some business, or uh, not have to just take a salary job and do something maybe that they don't love, because they just want to be able to do things in life, so they need this kind of pay. There's just so much more you can do to prepare them and set them up, so it doesn't have to be just for you, because you're already thinking, if you have family, you're already thinking, hey, how am I going to get these kids ready to live on their own? I mean, you think of that pretty early on, right, Doug? I mean, I know your
Yeah.
son's pretty young, but
Yeah.
I thought once you pretty much the time you figure out you're going to have a kid, you're like, okay, but you're just figuring it out as you go. But I say, well, if you're investing in your children, that getting them on with teaching them things, exposing them to knowledge, education. How about getting this banking system available, so maybe they're the ones that can go off and buy their house with their own banking system, or with the family's banking system. It doesn't have to be just because we can't, right? Even while we're adults, we can't do that ourselves, but we are planning for the future. It's just, where are you putting the money? And is it secure? And is it going to be paying you throughout your lifetime and the generations of your family? Something to think about for people.
It is something to think about. And one thing I'd like to point out, I mean, there's a lot of ways to become wealthy, but it's very difficult to retain wealth across generations. And anybody can go look into this. You can look at some of the wealthiest families in the world, and many of them don't retain that after even one generation.
Yeah.
But oftentimes, by the time they get to the second or third, someone will have squandered it along the way.
Yeah.
And when you look at families that have essentially passed on most of their wealth, or a significant portion of their wealth, often through trusts set up that own many of these policies, and they set them up on every kid that's ever born, those families retain their wealth, and they're taught, the kids are taught, from a young age, that they use those policies to do things to make more money. And by doing that, it's just perpetually growing. You're perpetually passing on more to your heirs, but in a form that's usable. And it also requires, it requires them to pay money back, right? So it requires them to be doing things with the money in order to make more money. So it's not just allowing people to, sit on their ass and go spend, millions of dollars a year. It's, hey, you have access to this, but you need to pay that back to keep this thing in force.
Yeah.
But anyways, I get a lot of pushback on that sometimes. Well, oh, it's only wealthy people that this makes sense for because of blah, blah, blah. No, it's kind of like which came first, the chicken or the egg. But the reality is that this works well for anybody at any income level at any time. If you like not giving your money to the federal government, and you like having the best access that you can have to your cash without interrupting the compounding process, this is really your only option. And I truly believe that it allows families to become very wealthy, after a few generations, or even in that first generation. It can really help to retain that.
Mm. Yeah. So, yeah, I think a lot about what you just said. It's just amazing that people have these ideas that sometimes are correct and sometimes really not. But I think you made some really good points there.
Thanks, John.
Yep. So I think that's a wrap.
That's a wrap. Well, I hope everybody can take some time to think about, any creative ideas they might have If you guys have any thoughts that we didn't think of, any fun ideas, we always love to hear about those. I literally am always hearing new things that people are doing with their policies to help their financial lives grow, and it's always interesting.
Yeah, it is. And that's again the imagination that Nelson talks
Exactly.
about and that's, I heard something today that I thought was funny. It was this athlete. They were focused on, he's a quarterback in college, and he says, I'm focused on plan A. He says, I don't even think about plan B. I'm still on plan A.
Mm,
But it is good to have some other, options. And that's what I think I like, is probably emphasize quite a bit, but I'll emphasize it more right now, is that this is about uh, giving you a lot of options, right?
yeah.
This is not about getting stuck in one thing, right? That because you can, again, you get to reuse the money. If you're getting the money back into the system by being an honest banker, if you decide I want to do something different this time, than what I used the money for last time, whatever it may be, uh, you can do that. But many of us, we end up, taking our cash, giving it for one thing. And the only way we get that money back again, right, is to literally think of it as always borrowing, right? You're always borrowing from somebody. And I think thing I will emphasize um, is, when somebody says to you, Doug, or says to me, like, well, this only works for the rich, right? Well, part of the reason only so-called only works for the rich is because only the rich are living this mindset, or the wealthy, right? I think you used the word wealthy, but the idea that they're always using somebody else's money. They
Hmm.
hardly put any of their own money into these things. They leverage somebody else's money. And that's what people that practice infinite banking, that's what they're doing. Is they're, yes, you had to start by creating this pool for the family, for yourself, whatever, right? And then leveraging somebody else's, leveraging your money to use somebody else's money. That's why these companies, like, I'll take Vanguard. Why does Vanguard own so much? I mean, they literally are the owners of these mega national companies, right? Mega global companies, because of the fact that they've been using our money, right? That's how the private equity works. They go to places that have the money, like pensions, like state pensions and so forth, that because there's money getting paid into those pensions, and they need to invest it somewhere. Well, private equity goes to them and says, hey, we got these ideas of these, we're going to buy a bunch of companies and we're going to cut you in on it, but we need your money to do it. They're always using other people's money until
Hmm.
people start to realize that's what you're doing when you create this family banking system or personal banking system. Is once you have that thing that you can leverage, then you're using other people's money, in this case the insurance company's money. So,
Hmm. Exactly. Yep. I fully agree with that. I just
awesome.
think to say that you shouldn't do what rich people are doing is pretty silly.
Yeah,
Um,
yeah, they seem to have figured something out, so why
right.
would you say only they can do it? Doesn't mean
Right. Yeah.
you can't do it at their scale, right?
No.
But it's just a matter of scale, and
Right.
eventually maybe you will be at some of these.
I'm gonna let everybody in on a secret. Every single family that is very rich now started off not being very rich.
Yeah,
At some point, somebody took action and started to do certain things differently and then retain that wealth somehow and passed it on. So
Yep.
you could be the person to start that.
Exactly.
And that's what John and I are trying to do in our lives. I know that.
For sure.
Yeah.
Okay, thanks for listening, everyone. We'll talk with you next week, Doug, and hope everybody joins us again.
Okay, it's actually a wrap.
It's official.
It's
Okay.
official. Have a
Bye
good
for
one.
now.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.